And joining us now on the debate of those 4 weeks that shook the financial world exactly a year ago. In Washington, D.C., Edward Harrison, editor of CreditWriteDowns.com, a financial commentary blog. In New York, Lawrence McDonald, author of A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers. In Newton, Massachusetts, Jeff Miron, director of undergraduate studies at Harvard University. In Kingston, Ontario, Louis Gagnon, associate professor, Queen's School of Business. And here in studio, Craig Alexander, deputy chief economist at TD Bank Financial Group. Thanks all of you, both sides of the border. Nice to see you again, Craig, for joining us tonight for this discussion of the very momentous events that took place 1 year ago this month that either did or we shall see how well they saved the financial world. During the course of our time tonight, I'm going to show you all 4 headlines from a year ago, and then we will discuss the events that took place that begat those headlines, starting with this one. This was in Business Day in Australia. U.S. takes over mortgage giants. This is all, Craig, of course, about September 7, 2008, the Bush administration taking over what they call Fannie and Freddie. Fannie Mae and Freddie Mac, 2 quasi-governmental institutions responsible for guaranteeing the mortgages that many Americans had on their homes. What message do you think the Bush administration was sending by taking over those 2 institutions?
Well, what we were seeing was the financial repercussions of the housing bubble that had burst in the United States and the lending practices that had been preceding it. In fact, Fannie Mae and Freddie Mac had been very heavily pushing increased home ownership in the United States at a time that we were also seeing extreme leverage in the housing market. Home prices went way too far too fast. A bubble developed and then it burst. But the interesting thing is that home prices had been falling in the United States for more than a year before we actually started to see the real repercussions in the financial system. But by the time we got to the middle of 2008, we started to get questions around the well-being and the health of Fannie Mae and Freddie Mac, which we refer to them as sort of quasi-private, quasi-government entities. In Canada, you'd think of them as crown corporations. And they were basically providing mortgage insurance so from a Canadian perspective, they were sort of like the equivalent to the Canadian Mortgage and Housing Corporation. But in fact, what the government was basically saying was that these quasi-government entities could no longer function on their own because of the losses that had been incurred in the real estate market.
Craig, that was a very thorough answer, and I'm going to invite all of our American guests to be shorter in their answers because it's only an hour show. Craig, come on, give me a break here, buddy. Jeff, take us back to that time. What signal do you think, I mean, this is a Republican administration taking over these 2 quasi-governmental organizations. What signal did the financial community take from that?
I think they took the signal that the administration was not going to let major institutions fail, that the fear that many people had that all of the debt that was guaranteed by Fannie and Freddie was implicitly backed by the U.S. Treasury was indeed backed by the U.S. Treasury, and therefore the financial markets took the signal they didn't necessarily need to clean up their own houses because somebody was going to come in and bail them out in case things went seriously wrong, as of course they did very quickly thereafter.
Edward Harrison, did this raise alarm bells that the government was willing to step in and free market principles, so to speak, be damned?
Well, it definitely did raise those alarm bells, but the government really didn't have that many options available, by and large, because the capital that Freddie and Fannie had just wasn't enough to be able to deal with the tides that were coming. One thing I think a lot of people forget as well is that a lot of foreign governments, including the Japanese, had major stakes in Freddie and Fannie paper. And they were making a lot of noises, the Chinese, the Japanese, about whether or not the U.S. government was going to make good on their paper. And by taking these organizations into conservatorship, the U.S. government protected those individual governments, as well as the broader financial markets.
So, Lawrence, take a look at the flip side. If the government had not stepped in, if they had not nationalized, so to speak, Fannie and Freddie, what do you think would have happened instead?
Well, that would have destroyed. I mean, those balance sheets were leveraged 65 times to 1. I mean, that's the equivalent of walking into a casino with $100 and playing on the tables with $6,500. So they had so much risk. The system would have been. I mean, Lehman Brothers' failure hurt the system. It really put us in a state of shock. I mean, Fannie and Freddie failing would have really obliterated the world economy, even much worse than even Lehman did.
Okay, you mentioned Lehman Brothers, and let's go to that because that's the second headline we want to look at. This was September 15th, 2008. There it is. World shares dive after Lehman Brothers collapse. Banks shore up markets. They all said Lehman wasn't big enough to fail, but apparently it was. Louis Gagnon, let's go to you first. Why was Lehman allowed to fail?
I don't really know. I think that the fact that Lehman was allowed to fail came as a big shock to everybody. If Lehman was allowed to go bankrupt, why wasn't Bear Stearns allowed to go bankrupt? The signal had been delivered already in March by the Fed and by the government that those big banks were too big to fail. So nobody expected Lehman Brothers to be allowed to fail. They were far bigger than Bear Stearns. So this was a complete and absolute surprise, a change in the script midway through, and this is really what caused the situation that we have witnessed soon thereafter. The entire financial system collapsed and the credit markets seized up.
Yeah, forgive me. Lawrence, let me go to you in New York, because you, of course, wrote the book about this, and I think it's actually instructive that Louis' answer, why was Lehman allowed to fail, we don't know, because a year later, you know, has anybody really who was involved in that decision explained to everybody's satisfaction why Lehman was allowed to fail but others were not?
Well, I think it was Louis. Louis, I think he was right on. I mean, this was really. I can tell you one thing. I've spoken to 47 senior managing directors at Lehman Brothers. I've spoken to people up and down the company in writing my book, A Colossal Failure of Common Sense. And I can tell you one thing. Hank Paulson, Tim Gagnon, they put the head of Lehman Brothers underwater and they watched for the bubbles. Lehman Brothers was almost twice the size of Bear Stearns, had much more systemic risk. They said the reason they saved Bear Stearns was that the systems weren't in place, like all these systems that we needed globally to stabilize the global economy and the U.S. economy weren't in place. And I can tell you one thing, it was a huge, huge mistake letting Lehman Brothers fail, because it made the bailouts of AIG and Merrill Lynch and GM and Chrysler so much more expensive.
Jeff, do you agree with that?
Well, I certainly agree that there was confusion over why Lehman was allowed to fail, but I think we have to think of it as part of the overall process, as was emphasized by, I think, Louis, going back to at least Bear Stearns, but even much, much earlier. There was a long, long history, indeed in the U.S., really a 200-year history of creditors not being asked to take the full brunt of decisions that they've made, accept the consequences of the risk they've taken on. In particular, in the 2000s, the Federal Reserve kept interest rates very low. It gave all these implicit promises that if things went bad, when the housing bubble burst, the Fed would somehow come in and rescue things. So then, when Bear Stearns gets partially bailed out or protected, not allowed to fully fail, everybody says, okay, that's the system we're in. And then they were completely panic-stricken when something completely different happened with Lehman. Now, whether it was a good thing to let Lehman fail, that's a whole nother discussion.
Okay, Craig, how do you answer it?
Well, I think that ultimately, I think there was a very fundamental question here around moral hazard, that if they bailed out everybody, would they be sending the wrong incentives to the marketplace? And I think that the rationale for bailing out or putting in support for Bear Stearns when the process started was that this was a real shock to the system, that it could lead to systemic risk. In other words, cause the grinding up of the financial system that we saw after Lehman Brothers. I think the government made a calculated risk, and I think they bet wrong on Lehman Brothers, because I think the basic assumption was that this had been going on for long enough that markets had basically anticipated, or at least were debating about the possibility that Lehman would fail. I think the communication strategy got very confused, because a lot of people were still expecting a bailout, and the U.S. government was concerned about moral hazard.
Lawrence, you want to come back on that?
Yeah, I would agree. Well, here's essentially what happened. Richard Fuld, our CEO, was walking around New York after Bear Stearns was saved with a false sense of security and confidence. And we passed up bids. The Korean Development Bank bids were there in the summer. We passed them up. Lehman could have sold itself. Hank Paulson was extremely annoyed with Richard Fuld for a number of reasons. First of all, we weren't aggressively trying to sell ourselves. Second of all, Lehman Brothers was still, talk about moral hazard, after Bear Stearns failed, Lehman Brothers was still investing in hedge funds. Lehman Brothers owned 7 different hedge funds. And I think at the end of the day, our banking system was in such bad shape in September that they needed Lehman to fail in order to get the TARP passed, the Troubled Asset Relief Program.
And we'll get to that one a little later.
And I think that's why they let her fail. But I would say, the one, I'll just wrap it up, there were tremendous friction and differences between Richard Fuld, our CEO, and the former head of Goldman Sachs, Hank Paulson. A big personality rift there.
And we should just explain to our viewers that you are saying we when you talk about Lehman Brothers, because you're not just the author of a book about the place, you used to work there. So that's why you say we. Edward, let me ask you about this allegation that many have put forward. The decision to let Lehman Brothers fail was either the best or the worst decision Hank Paulson ever made. Which category would you put it in?
Well, I'm going to take a pass, if you will, because it was a no call on his part, in that really, if you look back, I think both Bernanke and Paulson really weren't prepared for what was to come in terms of the financial crisis. Bear Stearns took everyone completely by surprise, especially Bernanke and Paulson. They expected the market to recover in some way in order to forestall more. You know, after Bear had failed, really you would have expected the government to prepare for a resolution process for too big to fail institutions like Lehman Brothers, like AIG, like Merrill Lynch, but they didn't do so. So when the time came for Lehman Brothers to fail, there was no resolution process in place, and they had to either bail them out or they had to let them fail. And basically, I think they made a political decision to let them fail. If you think back, I'm here in Washington, it's a very political place. I mean, there was all sorts of problems after Bear Stearns, and particularly after Fannie and Freddie were bailed out. All sorts of people were saying, what is this? This is crony capitalism, you know, this is socialism, et cetera, and so forth. And I think Hank Paulson felt that pressure. The Bush administration felt that pressure, and as a result, they let Lehman fail.
Louis, let me ask you a follow-up question here on this relationship between Henry Paulson, who was the then Treasury Secretary who had run Goldman Sachs, and Richard Fuld, who was running Lehman Brothers. And the relationship between the two of them was pretty terrible. We know that. Will you go so far as to say that one of the reasons why Lehman was allowed to fail was because of the personal antipathy these two men had for one another?
It's difficult to say, but it's clearly a possibility. I think that even Hank Paulson's behavior with Bear Stearns, in fact, betrayed a certain dislike of Bear Stearns itself as an entity. So he had manifested these types of feelings before, and clearly he's been working from a, you know, with a lot of background. I mean, he, having been in the industry, leading Goldman Sachs, he was dealing with a competition here, and this was an opportunity, I expect, to exact a premium on these people.
Lawrence, you want to go that far?
Well, you know, some interesting data is coming out. The Freedom of Information Act is an amazing act because we're now seeing Hank Paulson's phone records. And it's amazing. I mean, you know, in the days after Lehman, he's calling Lloyd Blankfein over at Goldman Sachs in the mornings. This is documented, and and then he's calling the other executives in the afternoons after the market's up 700 points on a rally. You know, I mean, I can tell you one thing: when Lehman Brothers failed, it made AIG's liabilities to Goldman Sachs explode. So in essence, when the government of the United States bailed out AIG, and they originally told us that there was $40 billion, all of a sudden, you know, a month and a half, 2 months later, it's up to $200 billion. Money, a lot of that, not a lot, but I'd say 12 to 14 billion of that went straight to Goldman Sachs. Goldman Sachs has almost been allowed to become an oligopoly because Lehman's not around, Bear's not around, and Merrill's not around, and they've been vacuuming up $1,000 bills every minute of every day since last September.
So we can't really say that we knew for sure that Hank Paulson acted in a way that was helpful to his own former business and injurious to others, but you can certainly say he had an apparent conflict of interest on all this. That's fair to say, right?
He'll never be accused of being impartial. I think that's certainly one thing.
That's the best way to put it.
Theorists will be talking about this for a long time.
Right. Jeff, let me read this piece to you here. Neil Ferguson wrote this in the Financial Times just a couple of weeks ago. He wrote, "If only Lehman had been saved and the stock market had not tanked, Michael Jackson would not have needed to commit to those 50 comeback gigs in London. He would not have felt so stressed and would not have taken all those sedatives. If only Lehman had been saved, Jacko would still be alive." Now, obviously, his tongue is firmly planted, Jeff, in his cheek here as he's saying all this, but there are a ton of what-ifs related to the Lehman bankruptcy. throughout September of a year ago. Tell us, in your view, how big the Lehman failure, how big an impact that had on the ripples, I guess, throughout the whole financial system.
I think that it's a mistake to put too much emphasis on the Lehman failure per se, because, first of all, a huge number of things had happened up to that point. At that point, I think Bernanke and Paulson really had no good choices. On the one hand, if they bail Lehman out, they've clearly said the moral hazard problem is there, in triplicate forevermore, because now we've made it clear that nobody ever pays the cost of their bad decisions, of their excessive risk-taking. If they don't bail it out, if they let it fail, then they worry about the repercussions. But I don't think that the simple failure was the thing which really spooked the markets, which really made everything go crazy. I think it was the announcement of the TARP. It was the fact they turned around and bailed out AIG. And it was the fact that there didn't seem to be any plan in place, any consistency in place. Nobody knew at that point, what the rules were going to be. So everyone froze, waiting for clarification, not necessarily just because Lehman had failed. Lehman deserved to fail. It had made bad bets. It had to go out of business. It was the huge amount of uncertainty and delay that was created by government policy that I think is what contributed mightily to the market meltdown.
Okay, we are going to get to AIG, and we are going to get to the, what's the one I'm looking for here? The last one, TARP. Thank you, Melissa. We are going to get to TARP as well. But I do want to ask, Edward, you're in a political town, as you just pointed out, and I wonder if you can tell me, had Lehman not been allowed to fail, could the TARP program have ever got through Congress? In other words, they had to show they meant business by letting one of those big players sink, because at the end of the day, that helped Congress pass TARP.
I definitely think it would not have happened. You saw that TARP was rejected on the first go-round, and it was only after much hand-wringing and a 700-point drop in the Dow Jones that we actually got TARP to be passed. Let's overlook whether it was a good program or not, but at a minimum, from a political perspective, it would not have been passed had we not had the failure of Lehman. Okay,
let's go to our third headline here, and everybody wants to talk about AIG. Craig, I'm coming to you first, and here we go. This is from Fox News, September 16, 2008. Here's the headline. Government bails out AIG with $85 billion loan. So, the chronology again. Lehman files for bankruptcy. The government bails out the American International Group with this $85 billion loan. Why was AIG more important than Lehman, and apparently, Craig, worthy of saving where Lehman was not?
Well, I think by the time we'd reached the point that AIG was now in trouble, the financial system was already starting to shake itself apart. In the wake of the Lehman Brothers failure, markets started to ask the question, okay, who's next? Interbank lending rates basically went through the roof. The financial system globally started to really run into major problems. And then you have one of the largest insurance companies in the world running into financial difficulty. At this point, I think that the financial system was so vulnerable that another major failure like AIG would have really caused the system to grind to a complete halt. And at this point, the government is basically in crisis mode.
Lauren, do you want to follow?
Well, Craig, the only thing I'd say to that is, I think you're right in terms of the VIX and everything, and all the TED spread and all the crazy things that people watch to measure risk. But it was only 2 days later. So when you say I think by the time, it was 48 hours to maybe 52 hours later. And what I think disgusts me, and I think disgusts a lot of people, is I don't know why our government just can't come clean. They said that they saved AIG because AIG had the collateral, and I use that word collateral in quotes, to justify saving. In other words, AIG's businesses around the world had the collateral to save AIG, and that was a bold-faced lie. AIG's businesses around the world are not worth $200 billion. They're not even worth $85 billion. They're worth somewhere between 40 and 60. So we were sold a bill of goods. We basically pumped $200 billion into AIG, and we let Lehman fail. And I don't see the difference between, in other words, in terms of dollars, AIG, which doesn't have the collateral, and Lehman Brothers, which had no collateral. I just don't get it.
Louis, let me get you to opine on this. The government took over 80% stake of AIG. What do you think that said to the world?
Well, basically, I think that the signal here was that the government had no intention of allowing the insurance sector to be sucked into this crisis. AIG was a very weird entity because it was the largest insurance company in the world. That is fine, well-regulated, well-capitalized, everything. But there was this small unit, AIG Financial Products, that was writing tickets all over the world and to all the big banks and the investment banks, including Goldman Sachs. They were basically selling these guys credit default protection. So they were basically standing ready to absorb all the losses, credit losses associated with all these toxic assets that these banks had been putting on their balance sheets. So basically, by bailing these guys out, giving them $85 billion, what the Fed was doing and what the U.S. government was doing ultimately was bailing out Goldman Sachs and all these other guys who stood to lose a tremendous amount of money because the default protection they purchased was worth nothing from that point on. So I think that, these are all complete miscalculations. Bear Stearns, Lehman Brothers, and AIG, really. I mean, they could have basically taken this little financial product unit, taken it out of the whole thing, and sort of unwound it cleanly and comfortably without doing all this stuff. But clearly, there was an agenda. They wanted to keep the investment banks alive.
Well, Jeff, was there, I do remember at the time, the point was there are so many other financial institutions around the world that depend on AIG. If we let it go, it could be that could be the unraveling of the whole financial system around the world. Now, a year later, did that argument make sense?
Well, I don't think it made sense at the time. A year later, it's sort of course, hard to say because we did have the TARP, we did have the bailout, and so people who think that it was necessary can say, look, yes, it didn't all unravel because we did the TARP. My analysis is it comes to a very different place. I think that basically the U.S. system had a fundamental misstructuring. We had built way too many houses. We had way too much debt based on these excessive building of houses and excessive housing prices that went with it. That had to get adjusted. Somebody had to bear the cost of these bad economic decisions. So yes, there was going to be a lot of pain. A lot of values were going to decline enormously, but that was actually the right thing to happen, the good thing to happen to get the position of the U.S. economy back where it could start to allocate capital appropriately between housing and non-housing sorts of activities. So yes, it would have been a mess. But I don't think it needed to be a mess for 3 months, 6 months, a year. I think it would have been a relatively fast mess, okay? And we've created the seeds of the next situation, of the next crisis, because of the moral hazard issue, because we bailed out all these people who took ridiculous amounts of risk, basically implicitly in the back of their minds, hoping to get bailed out if things went wrong.
I'm going to follow up on that moral hazard. Edward Harrison, I'm going to read a quote to you from Neil Ferguson in the Financial Times from a couple of weeks ago again. He says, if only we had learned from Lehman that no bank should be, quote, too big to fail, we might still have a real capitalist system instead of a state-guaranteed monstrosity that is the real legacy of last year's crisis. If only. Have these bailouts basically taken all the moral hazard out of the game now?
Not at all. In fact, I would say that we're looking at crony capitalism here. Let's take a look at the AIG situation as an example. Now, Washington Mutual was an organization that was in a lot of trouble and was seized by the federal government. This happened almost at exactly the same time that we looked at the AIG situation. Why was it that AIG was taken over by the government and Washington Mutual was practically handed to J.P. Morgan? Then you take another look at Citigroup, which is another large organization. They were pumped full of money over and over again. Why weren't they treated in the same way that Washington Mutual was treated? So again, you have a situation where certain institutions, J.P. Morgan, Wells Fargo, Citigroup, they all know that they're too big to fail. Not only are they too big to fail, they're bigger than they were before. In terms of market share, Goldman Sachs, in terms of investment banking, is bigger than they were before. J.P. Morgan, they have a larger credit card division than they did before. Citigroup is larger in terms of total asset base as a percentage of financial assets. So all of these institutions, they know full well they're too big to fail. They're bigger than they were before. They don't even need to show up when the president gives a speech on financial regulatory reform. None of the big CEOs of those institutions were there when President Obama was giving his big speech just a few weeks ago. I think that says a lot. So moral hazard is still with us today, and it's worse than ever.
Lawrence McDonald, you want to follow up?
I would agree 100%. It's worse than ever. Remember these words. These banks are not too big to fail. They're too big to succeed. They're too big to be managed. In 1998, Lehman's balance sheet when it was on death's door in 1998 was only $38 billion. Okay? Glass-Steagall gets dismantled around the turn of the century, and now Lehman has to compare and compete, and Bear Stearns has to compete with these big, giant, behemoth banks. So in 2007, Lehman's balance sheet went from $38 billion up to almost $800 billion. And the same group of people is managing that risk. These banks are too big to be managed, and I would agree 100%. You look at Bank America, okay? Bank America is a snake that swallowed 5,000 mice. I mean, it's Countrywide, it's Merrill Lynch, it's Bay Banks, it's Fleet. There's too much risk inside of these blobs. Capitalism does not work without transparency, and there's no transparency of risk. You can't see the risk because it's too blobby.
Okay, Craig, I'm going to read one more piece here from Martin Wolf, Financial Times, from a couple of weeks ago. Here's what Mr. Wolf had to say. Since large financial institutions are most likely to fail during a crisis, this amounted to an open-ended government guarantee. What makes the decision to bail out the banks quite unbearable is that it was, in my view, also correct. The risk of a cascading failure of the good and the bad and the ugly among financial institutions was apparent. Given what happened after Lehman's failure, only fools would have run this experiment. We were not that foolish. As hard as it is, as hard as it is for some people to swallow that U.S. banks are now backed by the U.S. government, would the economy be in worse shape if, in fact, they hadn't been?
I think the fact of the matter is that no price was too high to save the financial system. And ultimately, if you didn't do it, you were going to end up in a repeat of the 1930s. So I think it's reprehensible that you had to do what was done, but ultimately you needed to recapitalize the banking system. And in terms of this issue that moral hazard is still with us today, and I firmly agree that it is, I think this is going to be one of the root questions that we're going to be addressing as we look at regulatory changes in the global financial system.
Okay,
I think this is
that's to come, but I don't want to get you onto this other thing because I see Jeff shaking his head in Boston because, go ahead, Jeff, give us your theory on this.
Well, it's correct. The $64 million question is, would we have had another Great Depression if we just let all these institutions fail? And that certainly was the perspective that was advanced by Bernanke and Paulson. But I don't think the evidence backs that up at all. I don't think it makes sense, and I don't think there are data that show that. For example, if you look before 1914 in the U.S., we had zillions of financial crises. The vast majority of them were short. They were concentrated in a few cities or a relatively small part of the country. They took care of themselves. They were not associated with major recessions or recessions of any kind. A few of them were. Of course, there were some recessions, but those recessions were moderate, roughly the same size as most U.S. post-war recessions. They were not Great Depressions. So I don't think the evidence says from anywhere that allowing these failures to take place, allowing these panics to just work themselves out, leads to anything like a huge recession or a huge crisis. Indeed, we need to clear the books. We need to get transparency back. We need to have everybody know who owes what to whom and what is still worth something in order for the credit system to start to function again in a decent way. So I think that the bailout was really a total disaster, and the moral hazard is going to be haunting us for a long, long time.
Okay, 10 minutes to go. Let's do our last newspaper headline from a year ago. This one says, from the Wall Street Journal, Senate vote gives bailout plan new life. This is all about the TARP, the Troubled Asset Relief Program. And Louis, why don't you come in and start us off here and tell us basically what was this program originally set up to do?
Well, the goal of the TARP was quite simple originally. It was to purchase these toxic assets away from the banks in order to give them cold, hard cash and clean up their balance sheets. That was the idea, but it didn't work. The banks did not want to do away with any of these assets because they were still sitting on their books at inflated values. They had no desire to see these assets go at their fair market value, which was basically next to nothing. So the banks kept playing and wanted to keep having their own way. At the end of the day, it was the TARP was a spectacular failure, and Hank Paulson had to basically change his strategy halfway through and make direct investments, cash infusions into the banks by way of preferred shares or whatever you want to call them. So inject capital straight into the banks, which circumvented the entire problem of valuing these toxic assets and removing them from the balance sheets.
Edward, I want you to pick up the story because Vanity Fair this past month did a piece on essentially what went down a year ago, where essentially Hank Paulson calls all the, whatever it is, I think Vanity Fair said 9, but it might have been 20, of the chairman of the top financial institutions around the United States, calls him into his office. He says, sign your name to the bottom of this blank sheet. You are taking money. I don't care what your bottom lines are. I don't care what your balance sheet's saying. You are taking billions and billions of taxpayers' dollars to create confidence in the system. No questions asked, no one allowed to refuse. Was that the right thing to do?
Well, you know, I don't think it is the right thing to do unless, of course, you're trying to cover up who you're actually sending the money to. It's interesting. I was at the Clinton Global Initiative this past weekend, and Jamie Dimon was there, and he's one of the CEOs who says he never wanted to take the money. It was foisted upon him and so forth. He mentioned, and Sheila Bair was there as well, who's the chairman of the FDIC. They both said specifically,
the Deposit Insurance Corporation.
Exactly. What we really need here is we needed to have a resolution process. We needed to be able to make banks that are too big to fail, not too big to fail, such that we had a process through which they could go into a conservatorship or some sort of self-liquidating vehicle. And that's really what financial reform is all about. So ultimately, I think that the TARP was a very poorly disguised way of giving money to specific institutions that were weak, Citigroup and Bank of America as an example, in order to bolster those institutions. They spread around the money so that no one could say specifically, we're only bailing out Citigroup in this particular instance. So I think the TARP was a terrible idea, the way that it was executed.
Go ahead, Lawrence.
Well, I would say essentially this is really simple. One of the things I point out in my book, A Colossal Failure of Common Sense, is after Glass-Steagall was dismantled, the banks get absolutely enormous and giant. Years ago, when Continental Illinois failed in the United States, it was no big deal. Now, we had a situation last September where you have a 300-pound patient on the operating table, and he's flatlined. And our government, the TARP, the Troubled Asset Relief Program, essentially was two defibrillators, and they're putting that on the chest of the patient, and it was a ba-boom. And that is what needed to get the system up and running, because all of these banks were so big and in such bad shape that we needed really a shock to get things back to life.
Craig.
I think ultimately there was really the TARP was a colossal failure in the sense of when it first came in. It was presented as a rescue package to address the problem, and then it didn't pass on the first reading, and that created a crisis of confidence because it gave the perception that the government wasn't prepared to do what was necessary to save the financial system, and it showed the the divisiveness in Washington. Then there was the flip-flop on what the purpose of the plan was going to be, and again, this was a crisis. This created a crisis of confidence in financial markets because again, it made it look like the government was making it up as they went along. But I think at the root of the TARP purpose was basically to recapitalize the banks. And I do think that from the point of view of when they did go out and start giving the money to the banks through the purchase of preferred shares, the idea of actually giving it to everybody, I think it was regrettable that you had to give it to people that didn't want it. But ultimately, if you hadn't done that, I think you were basically going to put a gun up against the shares of the companies that did take it, and
well, that's it.
You would identify the weak points.
That's it. Everybody had to take it because they didn't want to identify who the weak banks were and who the solid banks were.
And I think that there was also a very powerful psychological dimension to all this, right? The government wanted to give sort of restore some confidence that they're actually taking action to save the financial system. And I think that the whole process ended up being a real mess because of how it was ultimately conducted. But they did need to repair the balance sheets.
Jeff, let me get you on this insofar as I think you've all been pretty clear about what you think the economic impact of it was. But you know, a year later, can you say that TARP did have some significant psychological positive impact on all of this?
Longer term, I think that's not clear. In the short term, I fully agree with the comment that was just made, that the way it was implemented, that the constant changing of what it was going to do and how it was going to operate generated huge lack of confidence. It indeed seemed as though they were making it up as they went along. Okay? I think that longer term, there's still huge antipathy to bailouts. People don't really know how to evaluate whether it saved the system or whether it prevented a Great Depression or not. They have their suspicions. And I think people are correctly very suspicious that somehow taking money from taxpayers and giving it to someone else in any way, shape, or form creates wealth or makes the economy more productive, it looks like, and because basically what it is taking from some people and giving to others. So no, I guess I don't think that it was important for restoring confidence. I think that basically the system gradually was healing itself, okay, and the TARP just generated a lot of noise and a lot of unhappiness and uncertainty that made the adjustment process even worse.
Okay, we got about 4 minutes to go here, and I would like to go around the horn with this question. Given the events and the choices and the decisions that were made over a 4-week period of time, 1 year ago this month, I want to know from all of you whether you think we have set ourselves up for worse crises to come, or have we mitigated against a potentially worse crisis down the road? Edward, to you first.
We definitely are setting ourselves up for a worse crisis down the road. The moral hazard is still with us. The institutions that are too big to fail are even bigger than they were before. The will to reform is actually less now than it was at any time in the last 2 years, in part because of the wildly successful ability to transfer income from taxpayers to the banks, which has caused the economy to seem like it's in better shape.
Okay, Edward, I'm going to chop you off there. Hang on one sec, because I've only got 2.5 minutes. I want to make sure everybody gets a kick at this. Lawrence McDonald, your view on this?
I agree. I think that these banks are bigger than ever. They're not too big to fail. They're too big to succeed. They're too big to be managed. We must break them up so we can identify the risks.
Louis Gagnon?
I agree that we've made things far worse than they could have been. The name of the game is very clear. It's whatever happens, we lose. So heads, they win. Tails, we lose.
Who's the we?
This is socialized risk-taking. Whenever the banks take huge risks, we know exactly who's going to come to bail them out, and it's going to be the taxpayer. This moral hazard problem is going to hit us again and again. I think that we have created so many precedents now that I'm extremely worried that the banks haven't learned the lessons, that we are setting the stage for another crisis.
Okay, Jeff Miron, your view.
I basically agree with everything that's been said. In particular, we are throwing money hand over fist at low-income, non-credit-worthy home buyers, okay, via the Federal Housing Administration in the U.S. We're continuing exactly the kind of policy which led to the housing bubble. It's no longer Fannie and Freddie. It's a different government organization. And so we absolutely have the moral hazard. We have the fact that banks are even bigger. And we have the fact that we're continuing to subsidize and encourage excessive risk-taking in the private sector that's implicitly guaranteed by the taxpayer.
U.S. government policy, a big 0 for 4 on this program so far. Craig, what do you say?
I guess I'm the odd man out, because I think that the odds of a renewed financial crisis are a lot lower now than they were. I think that we've seen a fundamental repricing of risk. I think that one of the things that got us here was that risk was being mispriced. I think ultimately we have been seeing a deleveraging of the financial system, and I think that the combination of these things make it less likely that we're going to see the problems that are being expressed. I think that though the crisis has created some major challenges, I think we're going to go through a very long period of financial re-regulation. I think it creates a lot of risks. I also think that we've created some major issues in terms of unsustainably large fiscal deficits in countries like the United States, and those are going to be major economic challenges down the road.
And those are future programs for which we need to have all of you back. Can I thank all of our guests for appearing on the program tonight, starting with Edward Harrison, the writer for CreditWriteDowns.com, came out of our Washington studio. Lawrence McDonald, A Colossal Failure of Common Sense. Your publisher's going to be happy with you. You mentioned the book twice on the show tonight. Well done, Lawrence. Jeff Miron, Director of Undergrad Studies at Harvard University out of Newton, Massachusetts. Louis Gagnon, Finance Professor at the Queen's School of Business in Kingston. And here in the studio, Craig Alexander, the Deputy Chief Economist of the TD Bank Financial Group. Thanks, gentlemen. Appreciate your time tonight.
Thank you, Stephen.
Now, for more information about tonight's guests and a list of the total bailout funds expended in the U.S. to date, visit us online at tvo.org/theagenda. Tonight's debate was produced by Melissa Martin, and you can read her post on an insider's account of the financial collapse. You'll find that on our Inside Agenda producers blog, also online at tvo.org/theagenda.